you. Let's start, guys. We just heard about an amazing thing in the last panel that said that they could send money anywhere in the world to any person using this crazy new technology called blockchain. Can you guys do that? And do you need blockchain to send money to people anywhere in the world?
Yeah, we can definitely do that. We've been doing that we started about 13 years ago, and we can move money instantly, as in 15 seconds, from an account here to most of the accounts in the world over the network we've built. And we do not have any crypto or blockchain involved in doing that.
Yeah, similarly, I think this is the first non-kind of crypto blockchain panel, but similarly, we send money to 5 billion bank accounts, hundreds of thousands of cash pickup locations between 170 countries, and 90% of our transactions are delivered in less than an hour, 24 hours a day, 7 days a week, and we also don't use any blockchain or crypto to do that.
So you're saying that you don't need blockchain or crypto to send money to people anywhere in the world?
No, I think the current technologies and the systems that exist can work pretty well.
All right, so when you're sending money to people in the world, because usually the first thing you hear about crypto is, that it's going to revolutionize everything, and then you talk about the use case. You say it's been 15 years after email, people are emailing each other, right? It's not being used in payments. This next thing you hear is it's great for remittances. And remittances is a subject that I've cared deeply about. Julapa mentioned it was actually the first hearing that I kind of helped organize as a young Senate Banking Committee staffer in 2001 for then Chairman Paul Sarbanes of the great state of Maryland. And eventually the legislation we worked on was codified in Section 1073 of Dodd-Frank, which I'll get to later. But let's just start with an overview. Talk to me about the U.S. remittance market. What's going well? What isn't?
Yeah, sure. I can start with the U.S. So the U.S., we send, as I mentioned, or we transact between 170 countries, but the U.S. is where we started. We also started about 13 years ago, and it's the largest outbound remittance market. About $85 billion is sent every year from the U.S., obviously across the globe. And when we started the business, it was about 9% to send money internationally, according to the World Bank. That has since come down to 6% due to a variety of reasons. We went public in September 21, so you can see all of our numbers. We're at about 2.5%. And take rate is not a perfect metric because it varies significantly based on average transaction size, and our average transaction size is just a few $100s. But the point is, by digitizing the experience, and more importantly, by building a trusted experience. I used to think it was just about price, but customers are providing a lot of their sensitive information to us: name, address, tax ID or SSN, date of birth, and then they're giving us a big percentage of their hard-earned money. And ultimately, it starts and ends with trust. Part of that is having a fair and transparent price. But because we have built that and continue to build that out, we've been able to really start to impact the industry. And yet, we're only about 3% of the global remittance market. So there's a lot of room to grow and continue to transform this industry.
Yeah, so by the way, Julapa introduced us as like foes. We are pretty good friends, actually, Matt and I. It's a very large problem.
Not by the end of the panel.
Yeah. So if you just take a step back, globally, there's about $2 trillion that moves across the world, across borders. And obviously, as Matt said, the US is a big part of the pie. And a lot of these people who are moving their money across the world, they're paying for tuitions, they're paying for medical bills, they're paying for supporting their families back home. And most of them are paying too higher fees. So as Matt said, it's gone down from 9% to about 6 or 5%. But we believe, eventually, if you look at what's happening in digital payments, nobody's carrying cash across the border. So why is it so expensive? If I send Aaron an email, it's actually smaller in transaction size from the bits and bytes that are moving if I were to send money to Aaron across borders. And of course, you can say there's a lot of risk and compliance work, which all of us have to do and onboard customers in a safe and compliant way, which we do. But then the reality is it still is too expensive. And then, as you said, it's very slow. They use the traditional systems of how money moves through correspondent setup. That's why we built a system where we connect directly to payment systems across the world. So we are directly connected to the UK as a non-bank. We're connected to Australia. We're connected to Hungary. We're connected to Singapore, and recently connected to Philippines. And that allows us to take out middlemen and really push the prices down. And these payment systems are evolving in their own speed, and domestic payment systems are getting instant and super cheap. So that allows us to then move money around the world in 15 seconds. And that's really how we do it.
So put a pin in that, because I noticed you didn't say that you connected directly to the U.S., and I want to get to that. But I want to get back to this path of remittance. You said $2 trillion globally. You said $85 billion comes out of the U.S. It's often 10% or more of GDP of countries like the Dominican Republic, El Salvador. It's often, I think, what was it, $1 billion a year went from Hawaii to the Philippines. There's very country-specific paths that tends to follow immigration patterns. Talk a little bit about the path of remittances in the United States, what you've seen, and what you expect going forward.
Yeah, so if you look at our three largest markets, it's markets like Philippines, which is, to your point, Philippines is actually 10% of GDP, and some Latin American markets, which are also large, it can be upwards of 20 to 30% of GDP. Just take a step back and think about that. 20 to 30% of GDP. And that means that means $2 to $3 out of every $10 earned are earned via remittances coming back from family members who have moved abroad. So our largest markets, though, are Philippines, India, and Mexico. And the service that we provide, it really helps transform a lot of lives for our customers and their families back home. And as Jalapa mentioned, I started the business after living in Kenya. But it's a massive force for good. And what's fascinating, going back to some of the blockchain and crypto conversations, because we've gone through a lot of hype cycles related to that, and I've had to scratch my head to say, like, can this really reinvent or bring down the costs of remittances, especially to emerging markets? And ultimately, it's really about understanding where the costs are in remittances to be able to bring those down. And the punchline of that, is on-ramping and off-ramping funds is where the largest costs lie. And that's where I think with additional scale, we've been able to bring down those costs, but there's lots of opportunity to continue to do so, and I'm sure we'll talk about that here in a minute.
So you said it's a force for good. I thought Donald Trump said that it was a force to suck money out of America and he was going to tax remittances to build the wall. Are remittances good? And they may be good for the recipient country. Is it good for America?
Well, I think if you look at immigration broadly and you look at the amount of taxes that are paid, you look at the amount of commerce and jobs that it creates, you look at the founding of a lot of the largest companies in the United States, let alone other countries around the world. And I would say that is a massive force for good, not only for the remittances of folks that send money back home, but also for the countries that our customers have moved from.
Yeah, I echo what Matt said. I think the money has been taxed already because it's been earned here. And then I think generally you have to think about, like, why do people leave their country and come to the United States? I'm one of them. I moved here and built something, and people use my product. And I think there has always been this desire and appetite to create stuff and do products, which brings people here, and the innovative economy that has existed here. So if you give a disincentive to do that, I think it might have other impacts. So we think it's a force for good.
So when I was getting into this, the fees were way higher than 9%. The fees were generally driven by Western Union and MoneyGram, and they generally were hidden in the exchange rate. So it'd say, come, for $10, we'll send you your $500 anywhere in the world. And the last time I looked, the most frequent remitters were the new migrants. They tended to remit 14 times a year, which corresponded to monthly and 2 holidays. Top 2 holidays, anyone? Christmas, yes, and Mother's Day. So if you think sending $300 to your mom makes you a bad person, you can be in column A or column B. But what would happen would be that they'd go in, they'd get this exchange rate that was often put to like 72 decimal places to purport like it was fair, when in point of fact, it was 20% off what, quote unquote, the market exchange rate would be. So in Dodd-Frank, we put into law Section 1073, which said you had to give consumers a price to shop, which was the amount of money that would be sent home in the recipient currency. So if I walk in with $300 to Wise and I'm going to send it to my mom in Mexico, you're going to offer me 975 pesos. If I walk to Remitly, you're going to offer me 976. I can make a choice on that. Does it really matter to me what the exchange rate is, what the payment is? And that's what we put into law. Has it worked?
First of all, good work. I do think this is one place where actually 10 years ago, 10, 11 years ago, the US did leapfrog, which was really good. Like actually, if you see, when we talk, because we are so global across so many countries, in Europe, for example, this is being discussed now and it's being put to law. But this definitely helped reduce and have the impact that Matt was saying, which was like going from 9% to 6%, dropping the fees. But transparency drives competition, right? So now people can compare. So they will pick the right provider, and eventually that will lead to providers to hopefully bring down pricing or go out of business. I do think it may not have gone as far as it should have, in the sense that I do think in some places you still see these services being marked as free. So, especially digitally, right? So when you go to the kiosk and stuff, there's maybe a different thing, but like a free transfer concept still exists, and all of that fee is being still put in the exchange rate. Yes, you can compare, but there is quite a bit of sneakiness that can still happen from a perspective of the source amount can change as you go through the flow and a few other things. But I do think it's been a great step in the right direction. And I think the recent CFPB actually put out a recent clarification to say marketing something as free on exchange rates while you're loading everything to exchange rate as fees may be seen as deceptive. And I think that's a good thing that we are clarifying.
So we should roll it back from the morning and tell him, go prosecute some folks for that?
Well, I think if we say free is not fair, if you are actually loading the exchange rate, then that should be good, because then people will start not saying it's free when it's actually got something in it.
Yeah, and I'd plus one to the work that you talked about, Aaron, and what Harsh said. I think that the fact that a customer could not see the amount that they were getting in the received currency was a broken part of the industry. Now, we were already doing that once some of that regulation was passed, but I think it's good for all companies out there to do it, and it's right to consumers to make it, a lot more simple and clear.
All right, so if we've said something that America did well, I'm going to turn to something where you may have a slightly different approach, which is accessing the money transmission system. You talk about having direct access in the Bank of England, you talk about having direct access other places. Can you have direct access to the banking system in the United States, and do you think you should?
Yeah, so the U.S. is a bit behind in this respect, although it's catching up. Let's go back to that point about what drives costs and remittances. There's a lot of other fixed costs in terms of compliance, regulation, all of those things. But if you look at the variable costs, it's how we collect funds. So let's go back to the customer, which I think is lost sometimes, especially in crypto or blockchain conversations, where if you go back to the consumer, we have to collect funds from a customer. And so in the US context, that's via ACH, which is a bank account and routing number, or that is via a debit card. And then we have to disperse funds, which is the 5 billion bank accounts, cash pickup, et cetera. How we collect and disperse funds are two of the biggest variable costs. And in the US context, unfortunately, the way that we collect funds with ACH is delayed 3 business days before you know the funds are good funds. And with a debit card, it's riding on card rails, so it's more expensive even though it's instant. Now, there are technologies out there that have been rolled out to banks, technology like FedNow, with the FTA and with Congressman Richie Torres out of New York, is passing new legislation. So specifically remittance companies who are highly, highly regulated, by state, I can go through that separately, but highly regulated can also get access to FedNow, because by doing that, we can bring down one of the 2 biggest variable costs and still enable that fast, seamless, trusted transaction while doing it at a lower cost for customers. If you look at a lot of our other European markets across the board, the central banks and or the bank transfer systems have already gotten there. And I think the US will get there, but we're pushing to get there faster.
Yeah, so I think Matt covered it well for the US. I'll just give you a perspective of the international landscape. It's what happened in the last, say, 9 years since we've been trying to get access in different countries. And we were the first non-bank to get access in the UK. So to give you a perspective, before 2017, October, November, when we got this, there were 17 players in the market in the UK who had direct access to instruct payments and have a settlement account. And then we became the first non-bank. After that, because we removed the sponsor bank that we didn't need, we dropped prices for our UK customers by 20%. That was the benefit for the customers. And then also instant transfers became instant. So we went from about 20 minutes to fund a transaction to 15 seconds. And then from there on, we've gone on to connect directly to different countries. But the US, obviously, we are still very, very early stage. And then the one thing I will also add is what has happened in the UK economy since that day. Now there are 33 institutions who are still, it's not like a carte blanche, everybody gets access, but 33 institutions in total, and most are non-banks, who've also gotten access on a risk-based approach where the Bank of England and central banks in all these other countries have assessed their business plan and determined whether this would be beneficial to drive competition in the economy, which has led to better pricing and better services for their customers.
So I see what you did, Matt, in trying to distract me by dropping a Fed Now reference. But I'm going to avoid that catnip and focus on instead the comment you said that you're highly, highly regulated. Because are you? You know, Undersecretary Nellie Liang put out a speech where she recently talked about possibly, essentially, having a national money transmission license, which the United States does not have. So you're state regulated. 50 states, District of Columbia, Puerto Rico, Guam, American Samoa, I can go on. Are all these guys really highly regulated and clawing through you all? Because I remember in plenty of contexts, for those of us who remember AIG as an insurance company, another state-regulated business, that had found some nice little loopholes, particularly in Tennessee, which was there was no place they'd rather be to be unregulated and buying subprime mortgages and insuring that. So, I mean, why should a company get access to a Federal Reserve master account and access to the central bank's payment network without any federal regulation and oversight?
Yeah, love that question. And don't worry, we'll have more time to talk about the what's going to be called the Affordable Remittance Act, because that isn't actually launched yet, but it's coming. So I'm giving you an early preview on that. But let's talk about the regulations. So, I mean, having gone through founding this company over 14 years, getting a license in every state in some ways is a lot more difficult than getting one national license. And I can say that with credibility because we also, from a national perspective, whether it's the FCA in the UK, whether it's the CBI, which is the regulator in Ireland that regulates us in the EU, Australia, I could go through a lot of examples, but we are regulated globally. And a lot of our state regulators, as you would expect, are very good at regulating money transmission. And so I think that we have a constant stream of exams because of the number of regulators we have. And I would argue that we are regulated at the federal level because we are under the purview of the CFPB and other federal regulators. The only reason that we're not regulated by the Fed is because we're not a depository institution. But if you look at the risks associated with moving money, which are very, very specific, I would argue that the current regulatory apparatus puts us in a highly regulated space for the specialty of which we do, and we're proud of that because I think that's critical to build and maintain trust with consumers.
So look, the Maryland level of Maryland regulation is obviously the best, but the question: should there be a national money transmission license?
I can take this one. I think it would help us as companies if there was one to work with one regulator. It would have the same requirement. The number of exams would be different, but like generally, I think we are moving money around the world. We are trusted by our customers. We want to make sure that, with a direct relationship with the regulator, we can basically work with one person and one regulator that helps us work across. Like the number of requirements are pretty different across some of the states, as you said. But generally, the bigger question is, I think what was being said was, should there be more of a payments distinction between the payments regulation and what you need to be doing as a bank, right? So step back 60 years ago, we had one assumption in the country, which was anything to do with money is done by a bank, right? We all lived through that, but now there are different applications, there are different things that people do. When you run your payroll, if you're running payroll only and moving money from one account to the other, you don't have to be a bank. But you are treated a license like that right now. So to get access to instruct payments, like other countries have done, having a payments charter, which would have its own requirements and considers the risks of being a payments company, I think that would be very helpful.
Yeah, so you make a very important point that's often lodged, which is that we assume that payments are part of banking. We define a separation of banking and commerce in America, very different than many other countries, as you're well aware, that's all about the taking of deposits and the making of loans. That's what makes you a bank legally. The movement of money does not. But technology has created a situation where you can move money back and forth. I think some of your competitors, MoneyGram, have at various points been owned by companies that have a bank within their context, much like we have a little bit of an idiosyncratic, some might call it schizophrenic relationship with industrial loan corporations. Target has one, Walmart doesn't, right? And that is a huge difference in access to the payment system. So I understand it for both you guys. You want access to the payment system. Harsh, you're willing to accept a federal regulator as part of that trade-off.
Yep.
Is that two?
Yeah.
And you are arguing that such access would result in lower prices.
Yep. And instant payments.
And instant payments. I see what you did there. I'm still not going to go there because we're talking about remittances. Why haven't costs come down further if you guys are offering a better deal? And yet there are bodegas and shops all around with Western Union, which last time I checked was the #1 advertiser on Univision. Maybe you guys have figured out a better, smarter digital media strategy than the last time I looked to reach folks. Why haven't prices come down further in competition?
I'll start with this. I think that there is, and I'm fascinated to hear your answer as it pertains to competing with banks. If you look at those bodegas, I will go back to what I was surprised 14 years ago when I started the business, that the business comes down, it starts and ends with trust. And so there is something about going to a physical cash location, knowing that person in your community, knowing in the back of your mind if anything happens from a privacy standpoint with your identification or from a it's a big percentage of their hard-earned money. Anything happens with their payment information and their money, that there's somebody in that community to be able to go back to. Now, what is shifting in a big way, and that's why you see it in our growth, is that increasingly people trust platforms like Remitly or Wise to say, actually, you know what, my friend has used this, it's a great product, and that word of mouth effect is something that once people switch and they have a great experience, they say, why would I ever go back to that physical cash location? But the reason it hasn't happened faster is trust. And trust takes time to build, but it is building in a big way for digital providers.
Yeah, there's two things. A bodega business is very different too. You're handling cash, which comes with a different kind of risk and different kind of overhead. I do think that you have seen the price of remittances go down, especially digital remittances, right, in the last 5 to 7 years. I think we have been part of that journey. We're moving $120 billion across our network per year, and that number is growing pretty fast. And payments is a scale business. So as the volumes go up, we can turn around and give that savings back to customers because the per transaction cost goes down. But we are seeing this happen. Would I like it to happen faster? Yes, but as we're early in the journey.
So let's talk for a second about that digital divide, which for those of us who did tech policy 25 years ago, that was all supposed to be an access issue. Now it turns out access is pretty, it's stunning, right? Smartphone adoption and income are uncorrelated. Think about that. $1,000 device uncorrelated to income. But you see a big divide in accessing digital situation based on the ability to access digital money, because there has to be either a debit card, you said, an ACH, a bank account, and do you guys take prepaid?
It depends on the market, but generally debit or local bank accounts. Yeah,
we do, but it's a small percentage.
It's a very small. So I have to have this account, which creates its own set of costs and burdens, particularly because I'm guessing that most of your remitters don't leave $1,000 constantly as their average daily balance in their bank account. What do you guys see as a potential way to leverage the product that you're offering for financial inclusion? Because when I was working on this 20 years ago, the dream was to have the banking sector take over from what Western Union, MoneyGram were doing, and to integrate that, to use Fed ACHI, to use other technology. And largely that doesn't seem to have happened. Citibank bought Banamex. There was a lot of momentum in this space, and instead there seems to be momentum in your world. What are the ways to leverage remittances for financial inclusion on both sides of the sender-receiver line? But I want to focus on the sender because let's be a little America first here for a moment.
Go ahead, if you want to start.
So I think actually, we do allow, using the prepaid product, we do allow you to hold balances also. Wise, you can go to wise.com and open up, as a US person, go through the KYC, the same bank level KYC you would need to do, and open an account. That's a different product than the send product. And we have seen people come from all different parts of the US who can hold funds with us, and then eventually when they need to remit, they use our product. So I do think, how did this allow us, how were we able to come to this product, it was because when we built a Send business, our customers started asking us for this. And they were like, oh, actually, I'd love to hold this funds also with you. And they could be different amounts. They don't have to. We could be the secondary account, not the primary account. But then they can hold funds and be able to provide the same experience in the end of the month to their friends and family and send money back home. So I think we have lowered that barrier. Also, the biggest thing about financial inclusion, I also think, is how do you put money back into people's pockets, right? So yes, access, but also saving them money to be able to even spend the money back here, so that every time when they're sending money back for Mother's Day, they're keeping at least $5 or $10 more in their pocket, so they can then take the kid out for ice cream is a good thing.
I want to go back to the fundamental example, because this is something that I also learned, like where you were talking about somebody who takes cash to a physical location. I think the presumption, I had this presumption, is that individual does not have a bank account. And I have had to challenge that assumption, which, if you think about it rationally, makes sense. And I had to challenge it when I would, in the early days of Remitly, we set up a physical location just to learn from customers. We've never offered a physical product, and we set it up in front of some physical remittance locations. And the behavior you would see is folks, and it makes sense, they would have a bank account with even some of the largest banks, let alone the local community bank or credit union. Those institutions are very good at what you were saying, depository institutions, lending. They have not built out, because it's really hard and takes a lot of specialization, the ability to send $300 back to the Philippines and to be picked up in minutes, whether it's cash pickup or a bank account or mobile wallet in the Philippines. And so what folks were doing, I would put them in the underbanked, banked being broadly defined as opposed to completely unbanked. They were going and getting cash because they also didn't want to pay those like card fees at that local, physical remittance location. They would withdraw cash from their bank, and then they would go give that physical cash to a remittance location or bodega. And so I think delineating between unbanked, which we don't serve, underbanked, which we are serving and providing a lot of financial inclusion to, and fully banked in quotes because it's a broad range of financial services, that is the shift that we're really helping our customers go through, and it's adding a lot of value to their lives.
Now, Matt, you're entirely right about that. One of the pieces of research I'm most proud of is I found that 70% of people who go to check cashers have a bank account. Think about that, 70%. You walk into a bank check casher, 7 out of those 10 people have a bank account. Well, why are they there to spend $20 at the check casher? Well, they get their money instantly there. It's 1 to 5 real person days, not business days, at the bank. And it's $35 per overdraft. And that's the situation there. So you're right that you're serving and by the way, the FDIC definition of underbanked is payday loan, check casher, or remitter. That's it. Those 3 services. Speaking of threes, we always like threes. And the question that I have for you, for people in this audience who are going to take away, what are the 3 takeaways? Because you're in a room with some of the most powerful, smart, well-connected people, many of whom probably never sent a remittance, probably never gone into Western Union, probably never really thought through the insights that you shared. What should they be thinking about to know about how to make the U.S. remittance market better, cheaper, faster, and more inclusive? What can we do?
All right. So we covered a bit about access. I think if the U.S. wants to continue to be at the forefront of payments technology and the payments industry, we need to step up and make sure that we have a framework where non-banks can get access. And this is for non-depository taking institutions, and whether it's through a payments charter, a different level of federal regulation, or through a different setup, but basically a risk-based approach that allows certain use cases to then get access such that you can instruct payments across the country will really, really help leapfrog the US ahead. And actually, I think we are now one of the only G7 countries that has not built this framework. So I think this is definitely holding us back. And with that, what we will get, and the citizens will get, is this lower fees and the trust and the ability to make sure that you know when your money arrives on the other side of the planet. Because usually, actually, right now, if you go to your bank account, where most of the payment instructions are starting, you will get this quality of service which says the money will arrive on the other side in 2 to 5 days. So that's one I would say.
You know, it's interesting. One of the things that came out a lot was when you sent $300 home to your mom, and $10 got scammed on BS fees and exchange rate, and you called mom and said, "Did you get the money?" she almost always said, yes, thank you so much. When you talk to them, we had a survey, Sergio and Dixon did a really interesting survey. Nobody said, yeah, but why are we $10 short? Right? The assumption was, it just came what it came, and you sent the best that you could. And there was a huge asymmetry of information for the sender to know what the recipient actually got. Was stunning to me how much was lost between cup and lip, so to speak.
And it's because of the intermediaries, right? The number of people, like, I think you mentioned this, like if you're a big bank, even if you're like a big US bank like Wells Fargo, you will not have direct connections in the Philippines, in Australia, because it's not your business. You don't have business there. So you will go through intermediaries, and the more middlemen you have, the more fees are skimmed. Sometimes the bank doesn't even know how much will arrive on the other side, which is crazy.
Yeah, before I say the three things briefly, I just want to say this has been really fun. Like, you're a really fun moderator, and I always love sharing the stage with you. And I also want to say, Jalapa, just huge thanks for organizing this, 8th year running, and such an amazing group. And to your point, amazing group. 3 takeaways I would say. First is that the product that both of what Wise and Remitly provides makes an enormous impact in the globe, an enormous impact to our customers, transformational impact in terms of how far those remittances go and what they do in folks' lives. The second is we are highly regulated, countless regulators. In fact, our chief compliance officer is here, Spiro, who used to be the chief compliance officer for Google. We have an amazing compliance team with amazing years of history. So second is we are highly regulated, both at the state and federal level. And the third is, the takeaway is, please understand the costs that actually drive higher prices for consumers when you hear anything related to remittance prices coming down. And the thing that this group can do specifically is help non-bank financial institutions, but specifically highly regulated remittance companies, get access to platforms like FedNow. And we are helping lead that effort, as I mentioned, coming up with the Affordable Remittance Act. But supporting that will help support this really important customer base to actually give them the product that they deserve.
All right. Well,
no,
I think we're out of the clock. Just saved you from my FedNow screen. So thank you very much, and appreciate.